All right, let's talk about a core investing concept that trips a lot of people up, rebalancing your portfolio. We're going to explore a much simpler and frankly, more effective way to think about it. It's a powerful method we're calling the don't sell strategy. Let's dive right in.
You know, this quote just perfectly captures what rebalancing should be. It's not about cashing out your chips and walking away from the table. No, it's about making smart, strategic adjustments, just moving your pieces around the board to keep your position strong for the long haul.
And that brings us to the big question, one that every single long-term investor is going to face eventually. When one part of your portfolio totally takes off and grows way faster than another part, should you sell the winner to buy more of the one that's lagging behind?
Well, the conventional wisdom, what you'd read in a finance textbook, gives you a pretty clear yes. You sell what's gotten too big. But the strategy we're looking at today, it flips that on its head. For most of us in the real world, the answer should actually be no. Selling is often a move you just don't need to make, and it can even end up hurting you. So why is that common advice so flawed? What's the big deal with selling? Well, that brings us to our first major point, the hidden costs of selling. Let's just get our terms straight for a second. When you sell one thing to buy another thing inside the same portfolio, the fancy term for that is internal arbitrage. It sounds complicated, but all it really means is you're shuffling money around internally to get back to your target percentages. The thing is, this internal arbitrage comes with 4 big downsides. First, and this is a big one, capital gains taxes can take a serious bite out of your profits. Second, you've got transaction fees every time you sell. Third, it opens up that dangerous door to trying to time the market. And finally, it makes you super vulnerable to all sorts of psychological traps, like panic selling when things get scary. Here's the bottom line. For a lot of us, selling becomes this emotional, knee-jerk reaction, not a calm, disciplined decision. And it's those emotional calls, the ones we make under pressure, that really end up damaging our long-term results. Okay, so if selling is the problem, what's the solution? Well, say hello to the don't sell strategy. It's all about rebalancing with the new cash you're putting in. Let's make this super concrete with a classic example. Let's say your target is 70% in world stocks and 30% in emerging market stocks. But, world markets had an amazing year, and now your portfolio has drifted to an 80-20 split. You're officially unbalanced. Now, the old method would say, okay, sell 10% of your world stocks and use that money to buy more emerging markets. But the don't sell strategy, it's so much more elegant. Instead of selling a single thing, you just direct all your new investment money into the asset that's underweight. So in this case, every new dollar goes straight into emerging markets until you get back to that sweet 70-30 balance. And the advantages? They're huge and they're immediate. You pay 0 sales fees. You don't trigger any immediate capital gains tax. You are automatically buying more of the asset that's, relatively speaking, on sale in your own portfolio. And maybe most importantly, it builds that crucial investment discipline without all the stress of trying to decide when to sell. I love this quote because it sums it all up. Rebalancing becomes about proactively using your new capital, your new ammunition, not about making a costly, reactive move. You're not fixing a broken engine. You're just sending reinforcements to the part of the line that needs it most. Right now, you might be thinking, okay, this sounds intuitive. It sounds simple. Maybe too simple. Is this actually legit? Well, let's take a look at the evidence. And the short answer is a resounding yes. This isn't just some convenient little life hack for investing. It's a real strategy that's been validated by serious academic and mathematical research. There's a key study from 2023 by Jay Bartroth that basically used mathematical models to figure out the absolute best way to rebalance using new money. And what they found, well, it confirmed that not selling is super effective because, you avoid taxes and fees. But the real kicker was the conclusion. Rebalancing without selling isn't just a good enough compromise. It is, in fact, an optimal strategy. And that brings it all back to what works in the real world. A comment from a user named Sandra really just hits the nail on the head. Simplicity is a superpower here. A strategy that's easy to understand, easy to stick to. Well, that's the one you're actually going to follow, and that's what makes all the difference. Okay, so we've covered the why, the how, and we've even looked at the proof. So let's wrap this all up with a really clear, simple action plan. Honestly, it boils down to just 3 simple steps. First, just stop. Stop feeling like you have to sell and tweak your portfolio every month or every quarter. Second, make your adjustments only by buying, by directing your new cash to whatever you're underweight in. And third, Take a look at the whole thing maybe once a year. You might need a tiny adjustment then, but only if things are way, way out of whack. So let's just recap those key takeaways one last time. Remember, rebalancing is about getting back to your original game plan, not chasing whatever did well last month. And the best way to do that is with new money, not by selling. Selling just equals fees, plus taxes, plus a whole lot of stress, so avoid it. Always point your new investments toward the assets you have too little of. It's that simple. When discipline wins over emotion, rebalancing becomes this gentle, almost automatic, and really effective process.
And we'll end with this piece of wisdom from the great Charlie Munger. The don't sell strategy is a really powerful idea, a great tool to have in your investing toolkit. So the question to leave you with is this: how are you going to take this idea and assemble it into your own personal financial strategy? Thanks for tuning in.